Hi there, I'm Edward Kalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Hermès, one of the most iconic and exclusive luxury brands in the world, home to the legendary Birkin bag, timeless silk scarves, and a heritage of craftsmanship that few can match. Hermès has long been a symbol of ultra high-end luxury. But how does Hermès stack up for investors right now? We're going to analyze Hermès using our 5 key factors to determine whether it's undervalued, fairly valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. First up, let's check if Hermès is efficiently turning its investments into profits, ideally with a return on invested capital and return on equity ratio that is above 15%. As of 2024, return on invested capital sits at 44.9%, whilst return on equity is 28.3%. Those are elite numbers, and they reflect Hermès' tight control over production, limited supply, and unmatched brand power. Even as input costs rise, Hermès' pricing discipline and high margin model help it maintain outstanding profitability. This is not a business chasing volume. It's focused on preserving exclusivity. That's why even in tougher macro environments, it doesn't rely on aggressive discounting or mass expansion. Let's look at growth metrics. Over the last 10 years, revenue grew at a compounded annual growth rate of 13.5%. Net income grew at a compounded annual growth rate of 18.8%. Earnings per share also grew at a CAGR of 18.8%, reaching 43.9 euros in 2024. Those are strong long-term numbers, especially for a company with such a premium position. But in 2024, Hermès saw a slight deceleration, with earnings per share growth flattening due to softer US demand and a slower Chinese rebound. Still, Hermès stands out for resilience during downturns. High net worth customers tend to spend consistently, and Hermès maintains wait lists for flagship items like the Birkin and Kelly bags, regardless of economic conditions. Looking ahead, analysts project mid to high single-digit growth through 2027. Not explosive, but solid and dependable. Hermès has one of the cleanest balance sheets in the luxury space. As of 2024, Hermès held 11.6 billion euros in cash and short-term investments, with 2.2 billion euros in debt. That's right, Hermès can easily cover its debt. Its debt-to-equity ratio is close to 0, which is rare for any global company. This gives Hermès maximum flexibility and a strong cushion to reinvest or return capital when opportunities arise. In short, the company is built like a fortress. Even great companies can make poor investments if you overpay. So how is Hermès stock priced today? Hermès currently trades at a price-to-earnings ratio of around 59. That's notably higher than other major luxury players like LVMH at 21.4, Richemont at 28.7, and Kering at 19. This premium valuation likely reflects the market's expectations for Hermès brand strength, consistent growth, and supply-driven exclusivity. Looking at the PEG ratio, which compares to price-to-earnings ratio to earnings growth, Hermès sits at approximately 3.1. That indicates a high valuation relative to its expected growth rate. While this doesn't necessarily speak to whether the stock is a good or bad investment, it does raise the question, how much of future performance is already priced in? And more importantly, can Hermès continue to deliver at this level? When it comes to luxury, Hermès might have the strongest moat in the game. The brand loyalty is next level. People are literally waiting years to buy a Birkin bag. That's not just high demand, that's obsession. And Hermès knows it. They control everything, from how the products are made to how they're sold. No wholesale, no discounts. It's all direct, and that really protects the brand's image. Plus, with wait lists for their top items and a timeless design philosophy, they're not chasing trends, they're creating them. That kind of exclusivity makes it tough for newer brands to compete. Now, it's not all smooth sailing. There are a few risks, like potential tariffs, stricter regulations around exclusivity, or better said, artificial scarcity, and changing taste among younger buyers. But Hermès isn't just coasting. They're investing heavily in craftsmanship, leaning into their brand legacy, and building out their digital game to stay ahead. Before we wrap up, all charts in this video are powered by FinChat. If you want to upgrade your investment research, check out the link in the description box for a 15% discount on FinChat's premium tools. In my view, Hermès is one of the most elite names in luxury, but its stock is overvalued based on our 5 key factors. Hermès has a return on invested capital ratio of 44.9% and return on equity of 28.3%, which is exceptional. Over the past decade, earnings per share grew at a compounded annual growth rate of 18.8%. The balance sheet is rock solid, 11.6 billion euros in cash against 2.2 billion euros in debt. But the price to earnings ratio is 59.2 and the PEG ratio is 3.1, which signals a rich valuation relative to growth. Hermès has a powerful moat, but at this price, the market expects a near flawless execution. What's your take on Hermès? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to analyze next. Thanks for watching, and I'll see you in the next one.